Hi, everyone. Thank you for tuning in. I'm Vladimir, an agricultural analyst with S&P Global Commodity Insights. Based in Singapore, where I lead the APAC research team covering the Asian grain, oilseed, and veg oil markets. I'm joined today by Dipanshi.
Hello everyone, I am Dipanshi, also an agriculture analyst on the APAC crops team based in India. I mainly cover Asian rice and cotton markets. Today, we will take a broader look at the global soybean and corn markets. So Vlad, let's start with soybeans before moving to corns.
Sounds good. Let's start with soybeans.
The big question seems to be whether China will buy any US soybeans in this marketing year. Can you set the scene?
Sure. Typically, the US exports about half of its soybeans between October through December. 2/3 of that is destined for China. But right now, China has no new crop US soybeans on the books. So the tariff waiver that's in place is set to expire on November 10th. And there's been discussion of a potential Trump-Xi meeting at the APEC summit in South Korea at the end of October. Now, even if relations improve quickly, logistics and financing lead times would push US exports into December, which translates to a potential loss of around 15 million tons of demand. Now, China has largely offset that by front-loading Brazilian imports from April through August, and will likely source another 6.5 million tons from Argentina throughout this marketing year.
It seems that the market is going through a turbulent time. Could China really avoid buying US soybeans altogether?
A good question. In theory, yes, but it would be costly. China still holds over 45 million tons of beans in reserves and has heavily relied on Brazilian beans since retaliatory tariffs priced US cargoes out of the market. That shift has driven Brazilian premiums higher and pushed Chinese crush margins into negative territory. So while China could sidestep US supplies, doing so is not cheap nor sustainable.
It shows a clear mix of geopolitics and fundamentals. And what else should we watch in the soybean market?
Two things mainly. One, the US harvest, and two, South American plantings.
So let's start with US harvest. How is that progressing?
Very well. It's been an excellent growing season. We expect a record yield of 53 bushels per acre, just a touch lower than USDA, although lower acreage means output will not set an absolute record. The result is still a large crop, though, facing weak Chinese demand.
And what about South America? There has been a talk of La Nina risk.
Yep. So Brazil is planting its 19th consecutive larger area, and we expect near record yields of around 3.6 tons per hectare. Argentina, they're switching some area into corn, and we expect slightly lower yields as we factor in a mild La Nina risk. Now, La Nina can bring drier conditions to Argentina and southern Brazil, though center-west Brazil often benefits. For now, though, we're only in a very mild La Nina, and Australia's Bureau of Meteorology expects a return to neutral conditions by perhaps early November.
So potentially, there's more supply on the way. So what does that mean for prices?
Let's answer this one through Chicago soybean futures prices. We see the market as having to price lower, particularly at the front end of the curve, to incentivize wider carries in order to store inventory.
Let's now turn to corn. Does the same bearish tone apply to corn as well?
That's right. Corn is facing the same bearish headwinds, albeit not because of a lack of demand, but because of a larger global production outlook.
And which producer stands out the most?
I'd say the US, once again. The same near ideal growing season means a record corn yield of 185.5 bushels per acre. And this is coupled with the largest harvested area since 1933, producing an absolute record of 16.7 billion bushels.
That's quite amazing. And how will US use that much corn?
Domestic feed and ethanol will absorb some of it, but exports remain key. Even so, carryout could climb to a very burdensome 2.5 billion bushels.
Are there any production risk elsewhere that might tighten things?
Not really. Argentina planted early thanks to good soil moisture, so we see production up by 9 million tons. Ukraine is up by around 6 million. So Brazil is the only steady one, with output roughly unchanged, although its exportable surplus will shrink slightly with a higher domestic ethanol mandate and rising meat production.
So globally, we are still adding corn stocks.
Absolutely. We see world ending stocks rising by 32 million tons from last year, pushing the stocks to use ratio up around 2 percentage points, the largest jump in a decade. Again, looking at where Chicago corn is priced, our expectation is that the market will need to do its job and price lower to generate additional feed or export demand.
So, in short, abundant global supplies for both soybeans and corn. A tough setup for the supply side, but a welcome one for the end users.
Exactly. Well summed up.
Thanks, Vlad, for the overview.
Thank you to Dipanshi, and thanks to everyone for listening. If you found this discussion insightful, please feel free to reach out to us directly. Be sure to also check out our research reports that dive deeper into the fundamentals and balance sheets of the soybean and corn markets. Thanks again, and until next time.